So you own a home and you're ready to move. You want to buy another home, but you aren't sure financially how to swing it, how to buy a home and sell a home all at the same time. Maybe you need more space. Maybe you're ready to downsize, or you're relocating to a different area. You want to sell one home, buy another home, but you just don't have the cash on hand to just go buy another house. So what do? Are you afraid of juggling a lot of moving pieces? Well, don't be. Selling a home isn't just about putting up a for sale sign. It's about strategy, marketing, and negotiation. But how do you know if you're making the right moves? I'm Judy Jernigan, recognized among the top 5% by the Atlanta Realtors, and your host of How to Sell Your Atlanta Home with Sage+Grace, Smart Homeowner Strategies, Successful Real Estate Sales. With a background in broadcasting, negotiation, and education, I bring a unique perspective to home sales, helping homeowners sell faster for top dollar and with less hassle, while understanding not just the financial side, but also the logistical and emotional considerations of a move. This show helps you plan ahead, navigate the market, and work more effectively with a realtor like me. You'll get expert insights from my guests, plus real actionable strategies to sell with confidence. Now, here's the show, moving you forward with sage advice and grace. Hi.
Hey, Judy.
I'm here today with Derek White, the buy before you sell guy. Welcome.
Thank
So we're going to talk today about niche lenders, programs that are out there to help people exactly this situation. And it is something that these lenders saw a need in the market and filled it. And likewise, you saw a need in the market to help people understand the different programs that are available and are filling it by doing just that. But first, before we dive into the whole buy before you sell niche programs, can we talk about what some of the traditional, if you will, options are for a person who wants to buy and sell all at the same time?
So the best traditional option would be for a client to go ahead and purchase the new home without selling their existing home. And that's making the assumption that they can come up with the down payment. They don't need to tap into the equity in their current home in order to purchase the new home. And also that their debt to income ratio will hold both mortgage payments. For clients who are able to do that, that's going to be the cheapest, probably less expensive option available out there. Once they purchase the new home and then say their old home sells a few months later, they can take the proceeds from that sale and they can put those proceeds towards the principal balance on the mortgage for the new home they bought and do what's called a recast. It's RECAST. Cost about $300 to do that versus doing a refinance, which would be thousands of dollars. The client can do a recast. Their principal and interest payment will be adjusted based off of the new lower principal balance. The rate doesn't change, the term doesn't change, but that's the ideal scenario and a traditional scenario where you don't need a third party buy before you sell company.
So I guess I should back up a bit. First off, if you can pay cash for your next home, for your second home, by all means, that's going to be the easiest option. Perhaps second and what more common is, let me just make sure I understood what you were saying, is if you're planning to get a conventional home for a conventional loan for your next home, you want to put down at least, are we looking at 3% for conventional loans?
5% in this case,
in
because
this situation.
it's not a first-time home buyer. The client already has a home,
Right.
so the minimum down payment is going to be 5%.
So 5% of the purchase price towards your down payment. And then you also need to be able, according to your mortgage lender's guidelines, be able to afford to have two mortgages at the same time.
Correct.
And the way that a mortgage lender is going to evaluate whether they think you can afford to have two mortgages at the same time is what the term you used, debt to income ratio.
Correct.
You talked briefly about what debt to income ratio means?
Yeah. So for a client, if they make, let's say, $10,000 a month gross income, so pre-tax, then their debt to income ratio, the maximum for a conventional loan is 50% of that. So $5,000 encompasses, in this case, both mortgages and any consumer debt that shows up on their credit report, car loan, credit card, anything like that. So their total monthly debt cannot exceed $5,000 in this scenario. So 50% of the gross income.
So if you're able to have two, in your example, you have two mortgages because you're owning two homes for hopefully a short period of time.
Right.
All of your debts combined, those two mortgages plus student loans plus car payments plus credit card bills cannot exceed 50% of your gross monthly household income.
Correct.
Okay.
Yep.
So that's not possible for a lot of people.
It's not.
And even if it is possible for people, they're not comfortable with that sort of situation and having to spend that much cash every month for two mortgages.
Right.
So this is where these niche lenders, buy before you sell programs, came about. And I think they can be such a good option for people to consider. But they're confusing.
Yeah.
There's a lot of different companies now that have gotten into this space. And it's something that I definitely try to keep up with and learn more about. But they get a little bit complicated.
Yeah.
And they change. They change their guidelines and their rules.
Yeah.
So I am thankful to have someone like you to help me through it. So what exactly is a buy before you sell program from basic level?
Yeah, so high level. For clients who have a home that they need to sell prior to purchasing a new home, these programs will make the client much more competitive on their offers by eliminating the need for a home sale contingency to be included with that offer. What these programs will do is provide bridge financing for the new home purchase, for the down payment. The bridge financing is calculated based off of the equity that the client has in their current home. So some percentage of that equity, these programs will free up in order for the client to use that for down payment on their new home. That's one aspect of it. The other aspect of it is the debt to income ratio issue. So these companies will put a backstop or a backup offer on the client's current home, the one they're selling. And in that case, the underwriter for the new home purchase does not have to include that old home in the debt to income ratio for the new home purchase.
Because it already has an offer on the table?
Right. Fannie Mae and Freddie Mac do not require that old home be sold, just that it have a binding offer on the home free of any contingencies.
Oh,
so no financing contingency, no appraisal contingency, no contingency at all. If it meets that criteria, which that's what these companies will do, then the underwriter only has to qualify the client based off of the new home mortgage. So two key aspects there. Essentially, these buy before you sell companies will bridge the client from the current home to the new home. And then depending on which company you go with, there's either a 4-month or a 6-month window in which the client has to get that old home sold. So that's a high-level overview of how it works.
So I've sometimes heard it described as you work with one of these companies and again, they're all a little bit different,
right?
But they will buy your next home or help you buy your next home. Well, I guess some of them buy your next home for you. Is that right?
That is. Any company that gets involved in the buy side of the transaction is not the company that I work with. I only work with companies that secure that departing home in order to free the client up to make the new home purchase.
So that's what you were saying. So the two pieces, they're going to see how much equity you have in your existing home, help you make a loan so that you can use that towards your down payment.
Right.
Go ahead and buy your next home. Meanwhile, you mentioned the backstop offer. They've made an offer on your existing home so that you meet these federal guidelines, right. Fannie Mae, which some people aren't familiar with. Maybe we should just say maybe we should describe Fannie Mae real quick.
Well, and let me say it's not a backstop offer. I think I used that term. I misspoke. It's a binding contract,
right,
that serves as a backup offer. But again, these programs don't work with FHA because FHA requires that the old home be sold. Okay. They don't have that same Fannie Freddie guideline that just requires that the house be under contract without contingencies.
Okay. I didn't know this nuance, and it's really important. So you have a contract to sell your home. Though you probably don't intend to use it because it's not probably as much as you're going to be able to get when you list it and sell it on the open market, which we can talk about. But this helps you qualify for getting the loan on your next home by reducing those debt to income rules.
Yep. If your debt to income ratio cannot hold 2 mortgage payments, then it eliminates the departing home mortgage from the equation.
What I love about this is it can help you get a better deal on the home that you're buying because you don't have a home sale contingency. Right. And it can help you get a better price for the home that you are selling because you've potentially been able to move out, move into your new home, and get the home that you're selling cleaned up, maybe staged, put the best foot forward for that home. So you're going to be able to get a better price for the home that you're buying. You're going to be able to get a better price for the home that you're selling. And those cost savings and cost earnings could very well offset the fees of the programs.
That's exactly right. That's exactly how a lot of these companies will package this when they're talking to you about it. Being able to sell and stage a home that's vacant and not have to coordinate showings around kids and dogs and all that kind of stuff will help a seller, sell a home quicker and at maximum value, ideally.
I should explain a home sale contingency. That is an option that we didn't talk about. Of course, you can pay cash for a home. You can do this where you carry two mortgages. You can try to, and I have done it, buy a home and sell a home all at the same day or within a few days of each other, have closings that are back to back. That is an option. And that often comes with a home sale contingency. And it depends on how hot the market is, if it's a buyer's market, a seller's market, how competitive the property is. We have seen in the local Atlanta real estate market that it has been hard to get offers accepted if they have a home sale contingency, but it's not impossible. It depends on a lot of other factors. What is a home sale contingency? It is when a home buyer says, I'm making an offer on this home. I want to buy it. Here's the purchase price, but I need to sell my current home before I can close on this one, full disclosure. And should something go awry and I not be able to close on my existing home, then I can get out of this contract and get any sort of deposit back. And so that's a lot of risk for a home seller to take. So those offers are understandably a little bit harder to get accepted.
Right.
So what are the typical costs associated with a buy before you sell program?
So there's a range. So the ideal situation, seller contacts you and then you get me involved early in the process before the house gets put on the market. So if you have a client who has 2 or 3 weeks that they can wait and kind of put things in place. And when I say that, I mean, what they're going to ultimately do is get a home equity line of credit against their current home that's going to serve as the bridge financing for the new home. For that type of situation, there's a company out there that just does the backstop contract on their current home. So a equity line of credit might be $1,500, and depending on the price point for the home that they are selling, this company that does the backstop offer might be another $4,000 or so.
A home equity line of credit is something that a homeowner can get from just about any lending institution.
Yeah.
But the difference with some of these, what I keep referring to as niche lenders, and we'll name names in a few minutes, is that they're going to add that binding contract to the mix.
That's right. So looking at the scale of it, to answer your question, I did a pricing scenario with all of these different companies that we work with. The scenario was a home being sold at $500,000, new home purchase at $700,000, with a bridge loan of $200,000. So that was the scenario, and I ran the pricing through each one. On the least expensive end of that, it was roughly $8,000. On the most expensive end of that, it was $18,000. So you might say, well, why in the world would anyone do the option of $18,000? And it's a good question. With the less expensive one, that's the one where your house cannot be up for sale, cannot have been listed within the last 6 months. So there's different criteria for each of these programs that a client may not be able to meet. So if someone comes to me and their house is already up for sale, listed for sale, and they're ready to make an offer tomorrow, they're not going to qualify for that $8,000 option.
Because the bridge loan lender is taking on a bit more risk.
They will not lend. Yet. You cannot get a HELOC on a house that's already listed for sale.
Okay.
So ideally, you and your client are going to get me involved on the front end
to help weigh all the options.
Right, to help weigh all the options. And if we have 2 to 3 weeks lead time, then we're going to go get that equity line of credit. At the same time, putting things in place with this company that that does just that backstop offer. That 2 or 3 weeks lead time could save, when the scenario I gave you, $10,000 as far as these costs go. Where the most expensive one comes into play and is relevant is that they'll offer this program on properties and scenarios that really no one else will, like condominium or rural property, or there's all kinds of scenarios where some of these companies have a very small box that they will lend in, whereas that company on the more expensive end has a much wider buy box, is what we call it. They'll offer this program in scenarios that nobody else will.
So with the differences in fees, where you mentioned if your home is already listed for sale, no lender will give you a HELOC, a home equity line of credit.
None that I'm aware of.
So, but there are ways to still get a bridge loan?
If the house is listed for sale, then right there, of the 4 companies we work with, we're going to eliminate one of those right there.
Right, so
but there's still 3 others that we'd run the scenario through and get pricing and get a proposal and would not be off the table just because the house is listed for sale.
So you have at least 5 companies. You keep your finger on the pulse of how they're doing things and what fees they charge.
Correct.
And I know they change regularly. Tell us how you are affiliated with those companies.
I'm
your
actually,
background.
Yeah. I'm not directly affiliated with any of them currently. I use those programs. I leverage those programs to what I do is I'm a mortgage loan originator. So I leverage those programs in order to get the opportunity to increase my mortgage origination business.
It's a customer service that you provide.
That's
so
exactly
you don't
right.
have any loyalty to any of the
I have
particular
none.
companies,
Yeah.
right? Which I love that. So you're
Right.
giving us an impartial evaluation of what the options are.
That's exactly right.
Just to help better serve our clients.
Yeah. It's a free service that I offer. Is I'll get basic information about your client, the home they're selling, and the price point of the home they're buying. I don't need social security numbers, date of birth, anything like that. Just general information. And what I do is I will run that scenario through all 4 systems. I'll get, within 24, 48 hours, I'll have proposals from each of those companies. And then from there, I'd like to pare it down to the best 1 or 2 proposals. I'll present that to the agent and also to the client. And that would be going over, on a high level, going over how much, this is how much they're going to free up for you for the bridge loan financing. This is how long you have to sell your house once you buy your new one, things like that. Hidden fees. I try to uncover all of the things that the client isn't necessarily going to be asking about.
Yeah, everything they need to know to make an informed decision for
Exactly.
themselves and their families. So let's name names. What are the companies that you help us evaluate?
So Calque, Calque,
and they're newer to the scene.
Is very new. They are the company that does not do bridge loan financing, but they will do a backstop contract against the home. So that's the scenario where the client cannot have their house listed for sale. They'll get a HELOC through their bank, or I also have contacts, banks who will do HELOCs that serve as the bridge financing. Calque is the least expensive of those 4 options. But again, that was a smaller buy box.
Their niche is to say, we will guarantee that we'll buy your home should you need us to. And it helps check that box that you have a binding contract on your home, even though you probably don't intend or hope to actually sell to them.
Yep.
Okay.
That's right.
Interesting.
Work with UpEquity. That was the company that was on the higher end in not all cases, but some cases cost-wise. They've got the big buy box. I actually used to work for UpEquity for 2 years. I was a business development rep from 22 and 23 with them. So I know that product very well.
But no longer affiliated?
No longer affiliated anyway. I do not get
paid by them or anything?
I get no kickback. I nothing. But the knowledge and experience that I have with these programs, and I know that there's a need for these programs in the market. Yeah. That's why that's a big part of the business that I do. As far as the origination goes.
Calque, UpEquity.
HomeLight, very good option. And Knock, who's probably been around longer than anybody in this space. So we work with them as well. So those are the 4. And then there's a 5th one that maybe coming to the market. I don't know for sure, so I don't want
Okay.
to mention any names.
Okay. Is Ribbon still around?
I think so. I don't know.
They were a player in the space. This was 3-4 years ago.
Right. Ribbon and Homeward, they're companies that get involved in the buy side.
With the buy your next home and
so
like rent it back to you. So that's a different option, a different conversation.
Right.
Okay.
Right. And I don't, because we are handling the financing, the mortgage on the purchase transaction. I don't get involved with, I don't want, those companies can kind of get in the way with some of their overlays and their processes that slow that purchase transaction down. And so I don't work with them.
So I meet a homeowner who is ready to buy their next home. They do have a home to sell. I'm going to put them in touch with you. You're going to get to know them and their situation and find out if they can swing things just as it is, traditionally, conventionally, or if they need one of these niche programs with the bridge financing. And your ultimate goal is that you hope by providing them lots of knowledge and good customer service that ultimately when they do buy their next home, they'll get the mortgage with you.
That's exactly right. I offer this free service. And what I ask for in return is the opportunity to compete for your mortgage. I'm not asking for any promise or guarantee. Just give me the opportunity to compete with a mortgage. And what I'll say is if I am doing the mortgage, then the process from there to closing, I act as a liaison between these third-party companies and the client and the agent. These companies, not all of them, but their customer service could be better at times. So I help with that, help smooth that transaction, help smooth that process. And again, uncovering those potential landmines like hidden costs and things like that. Perfect. They all have them, and I know kind of where the landmines are. And so I help smooth out that process to the closing.
So you mentioned condos earlier. What types of properties are best suited for this type of bridge financing niche situation?
Properties that are in not urban areas, but not out in rural areas that are within the city limits or inside. With Atlanta, be the greater Atlanta bubble. That would be ideal. Ideally, a single family residence. Although there are some companies that will do condos. Ideally, it's a primary residence that the client is going to be selling. Although companies like UpEquity will do an investment property. That's again, sometimes UpEquity is the only option, but they serve that purpose. They can get a client who's stuck trying to do things the traditional way, get them unstuck and get them to the finish line. It certainly serves a purpose. It's not a one size fits all. I tell people that all the time, but it's certainly worth investigating on the front end and weighing out the costs and the benefits.
So what happens, I think people are going to be wondering, if the home that they bought their next home with this bridge loan, what happens if their old home doesn't sell as quickly as they hoped?
Yep, great question. All right, so we're talking worst case scenario, which your clients will ask. So I'm going to talk about each of the companies in general, other than knock. I'll tackle knock in a second. Okay. So depending on how long, UpEquity gives the client 6 months to sell after they buy the new home. HomeLight gives 4 months to sell, and then Calque gives 5 months. Okay. So what happens at those deadlines, whatever company you end up going with. So let's just say it's UpEquity. 6 months after your client purchases their new home, their old home is not sold yet. UpEquity will then move in and purchase the client's old home at the specified price that was laid out and disclosed on the front end.
In that binding contract.
Binding contract might be 85% of list price. Let's just say that for now. Of whatever the list price was on the front end of the transaction. So they will purchase that home at 85% of the list price. With that transaction, they'll get paid back their bridge loan or their equity advance. They'll also pay off the mortgage for the client's old home. And if there are any proceeds left, then the client will receive those proceeds. But it's a two-step process. So, I know what you're thinking already. These aren't iBuyers. So the client's not coming in and taking a 15% haircut. What happens is
super low ball offers.
Well, yeah, it's not. Ultimately, the client's going to get full market value with each of these companies except for Knock.
Okay.
So what happens is once, again, we're talking about UpEquity. Once UpEquity purchases the home at 85%, then you as the agent will relist that property to be sold a second time. And the reason you have to relist it is because it's a different seller. So it's a technicality, but you have to relist it. So that home will then sell a second time at full market value, whatever that is.
Most we can get on
the market will determine that. UpEquity does not determine that. From there, the agents, with that second sale, full market value, agents will get paid their commissions. And then depending on the company that you're going with, there may be some carrying costs that accrue, but whatever is left over once the costs are paid from that second sale, the client will get a second round of net proceeds to match the first round that they got. And then the combined of which will equal full market value. Obviously less, the costs involved, agent commissions, and if they're any carrying costs. But ultimately, the client's going to
pretty fair.
Yeah, ultimately the client's going to work their way up to full market value. It does get more expensive once you cross that threshold of however many months that the company allows. So
as with any home sale or listing, you want to price it correctly, fairly, out of the gate. Right. Don't have it sit on the market a long time. Let's get it sold.
And what I tell agents when I am talking about this program is if the client's home has not sold 90 days after they buy the new home, that's probably a good time to have a conversation with your client about list price.
Right.
Again, we don't dictate or
all those things, showing conditions. And so these niche lenders, they are not iBuyers, as you call them. They really don't want to buy your home. They're not interested in gobbling up real estate. That is not what their business model is.
Yeah.
That's a relief to hear.
Yeah.
That's not their end game, their goal at all.
It is not, except when talking about Knock, and these programs change all the time. This is based off of Knock's guidelines the last time that I looked at them. Yeah, with Knock, at the end of that 6 months, they give you 6 month window to get the house sold. At the end of that 6 months, you don't have the two-step process. Knock is going to purchase that home at 80% of the list price, the lowest list price throughout that 6 month period. So in that scenario, your client does take a 20% haircut. So ideally for that program, Knox is if we're gonna steer a client that way or kind of open up that avenue for them, you want to be pretty sure that that's a property that's not going to be sitting on the home. On the market.
So for context, at the time of this recording, homes in Atlanta have been going under contract on average in about 32 days. So there is still a lack of inventory in Atlanta. And if you have a home to sell, we are able to get it sold the vast majority of the time within a month or two. If it needs some work, it doesn't show well. But these all giving us 4, 5, 6 months. That should be plenty of time.
Talking worst case scenario. It does not happen very often, but it's important to understand it.
What other risks or downsides should homeowners be aware of?
Nothing that we have not covered already. I mean, obviously the cost risk-wise is getting to that period that whether it's 4 months, 5 months, or 6 months, depending on the company, and then additional costs being involved in that case. But I can't think of any other risks other than that.
That's what you're so good at, is helping people understand how it works, what they gain, what they pay. I love that. Yeah. So do you anecdotally have a success story you can share with us? Maybe some homeowners who've really greatly benefited from this program? Yeah, I mean, several I spent 2 years as a business development rep for UpEquity, as I said. So there were several, not one I can think of offhand, but clients who spent months trying to do this
selling and buying the traditional way, spun their wheels, would get under contract. That contract would fall through because of the contingency, just over and over. And then we were able to, get them signed up on this program, and kind of get where they were stuck, get them unstuck and get them across the finish line and buying that new home. Again, I've been in this market for 25 years. And what attracted me to these programs in general is that I know that there is a need in this market and probably every major market for a program like this. There are a lot of clients out there who might be stuck trying to do it, or there are also a contingency of clients who don't want to mess with it. They don't want the hassle of...
They're afraid the fees are going to be exorbitant.
Right.
And they're so confusing if you go to the websites comparing them and understanding the programs. So,
and that's where I come in. I mean, I'll navigate, I'll make it, put it all in layman's terms as best I can. And again, and this is easy for me to say, the fees are not paid out of pocket. They are paid basically directly with the equity in your current home. Doesn't make it any easier to swallow in some cases, but
it's not tapping into your cash reserve.
It's not tapping into your cash. You're not stroking a check for, and that's
a good point.
One case is $8,000 or $18,000. But
I love
it serves a purpose.
Yes, I love that these niche lenders exist to fill this need, and that you keep on top of how they all work and can help my clients understand them. So I appreciate you.
So we didn't really get into this, but some people think that they have to sell before they can buy a home.
Yeah, they'll walk into this process assuming that they have to sell before buying, when in reality, they might have access to 5% for a down payment, either their own funds or gift or a combination of both. And their debt to income ratio may hold both mortgages. If that's the case, even if they're putting 5% down, but ideally they're planning on putting 20-25% down, for instance, they can go ahead and move forward, buy the house with 5% down. Once they sell their old home, they can take those proceeds, put them towards the principal balance of the mortgage for the new home, and do what's called a recast, R-E-C-A-S-T. Recast will not only bring your monthly mortgage payments down in line with the lower principal balance, but it will also eliminate mortgage insurance if you had to initially get it when you bought the house.
Because your down payment was only 5%.
Right.
Now that you have 20% down or equity, then you're... Okay.
As long as you meet that 20% threshold with the recast.
With the recast, can your interest rate potentially go down?
No. So that's the only thing that changes. Your loan terms stay the same. The length of the loan stays the same. Your interest rate stays the same. The only thing that changes is the principal and interest portion of your monthly payment is adjusted to meet that new lower principal balance. It is $250, $300 versus a refinance, which, as we know, $7,000, $8,000, $9,000 depending on the size of the home. So the recast is a fantastic option that many people do not know about.
And the recast has to be done within how many months of that initial closing?
There's no limit on when that recast has to be done. You can do it. I think the limit is you have to wait at least 2 months, I think, to do the recast. But after that, you can do it in month 3 or year 3 or year 13.
Oh,
yeah.
I didn't know that.
And some companies will limit to one recast. It just depends on the loan service you have. But everyone that I know of at least allows for one, which is all you need in this scenario.
So that way they can go ahead and move forward without having to use any of the niche programs we've been talking about.
Exactly.
If they have 20% saved up for a down payment, they don't have to use it all right away.
Yeah.
Right?
Yeah. They can, if they have 5%, access to 5%, they can make that transaction happen and then go back, and then the recast will get them ultimately to where they were planning on being with, whatever down payment. So it's a great program.
It is a great program.
Yep.
Thank you. So I'm thinking about this particular couple. They're saving up for a down payment. They're probably planning 20% down.
Yeah.
What advantage would they have moving forward? Even if they have 20% saved, I'm thinking that they still may not be able to carry 2 mortgages
Yeah.
because of the 50% rule. So that's what they need to understand, that maybe there's no point in waiting because you're still not going to be able to do it.
And in that case, if they have the funds, but the debt to income ratio doesn't work, we get Calque involved. Calque puts the backstop contract on the old home for a significantly lower fee than what the other ones, and that frees them up to make that new home purchase.
So it's never a bad idea to be saving up, but it may not get them where they want to be, which is to be able to buy their next home, move into it, carry 2 mortgages for a while. They still may not be there.
And the downside to doing it the way they want to do it is values going up.
Yeah.
I mean, you can buy now and realize that appreciation yourself, or you can buy down the road and you're paying that higher price. So.
Where can people find you?
Yep. So my cell phone number, 678-778-2921, or you can email me at buybeforeyouSellGuy@gmail.com.
Awesome. Anything we haven't thought about talking about?
No, just again, kind of reiterate, the sooner in the process that you get me involved, the better the opportunity the client has to get through this process with the least amount of cash or cost that they have to pay.
The sooner you get involved, the sooner you can help them start finding the most cost-effective solution to help them buy before they sell.
That's exactly right.
Thank you.
Thank you, Judy. Appreciate it.
I am Judy Jernigan, the team lead and founder of Sage+Grace Realty Group. This is How to Sell Your Atlanta Home with Sage+Grace, smart home owner strategies, successful real estate sales. Thanks for spending some time with us. Thanks for joining us on How to Sell Your Atlanta Home with Sage+Grace. I'm Judy Jernigan, and I love helping homeowners sell smarter with less stress and better results. Who do you know with real estate questions? Please connect us so we can make confident, well-informed decisions and get the best possible outcomes together. If you enjoyed this episode, be sure to like, subscribe, and leave a 5-star review. It helps more homeowners get the smart strategies they need for a successful sale. Head to sageandgracere.com to learn more about working with me and the Sage+Grace real estate team. Explore all our show episodes, and when you're ready, book a chat directly with me, Judy Jernigan, moving you forward with sage advice and grace.